Hi, this is Jared Snider with Exencial Wealth Advisors, and today we're going to talk a little bit about some strategies to use to accomplish some different goals, solve some different problems for you, particularly for where we are in the market today. So a few questions that I've gotten from clients, from individuals, has been around putting cash to work, how to go about putting cash to work right now given where the market is, given some of the events that have transpired this year and that are still to come with the election here in a few weeks. I've had questions from clients around just where can we get yield in the market today whenever interest rates have fallen. We have much lower rates than we did even a year ago. And so what do we do with cash? How do we get cash productive? And then, kind of thinking through if we're putting cash to work in the market, how do we go about doing that? If we're wanting to kind of on-ramp into the market, or if we're wanting to off-ramp and reduce some exposure in the market, what are some ways to go about doing that? So I have a strategy today to discuss with you to give you some color there and just one more tool in the toolkit to be thinking about. So those are kind of the problems we're solving for, maybe reducing some exposure in the market or figuring out how to get into the market, and then looking at some ways to increase the yield on cash. So the strategy here, what we're looking at is trying to obtain higher yield, say a 4 to 6% yield on your cash. Avoid investing in stocks right away at today's prices, but being willing to invest in stocks if we saw a decline in the market. So let's say that markets were to fall somewhere in the range of 12% to 20% from today's prices. If we're willing to buy into markets at those prices, this strategy would be a good consideration for you. So what does this strategy even look like? What are we actually doing here? What we're actually doing is selling cash-covered puts in the market. So I'll just preface this by saying, yes, these are options trades, and sometimes that can sound complex, but it's pretty simple. It's pretty straightforward for what we're doing here. Whenever you're selling a put, basically you're acting as the insurance company. We all pay insurance premiums, and sometimes we kind of grumble about paying those premiums. We pay it, the insurance company collects it to insure against a risk. Whenever you're selling cash-covered puts, you're acting like the insurance company. Basically, you're selling the puts, and someone is buying the put, and they're paying you a premium for selling that put. So let's say if we're selling a put and that contract is going to expire in several weeks, we're going to sell that put based on the market dropping to a given point, somewhere from 12% to maybe 20% down from where the market is today. And so if we sell that put contract at, say, a 15% market decline, and we set the date for that contract out, say maybe 2 months from today, if we don't see the market have that 15% decline, we've just collected our insurance premium, and then whenever the contract expires, we're in the same position we're in right now, which is we have cash, and we have to evaluate what to do with it. On the other side of the coin, if markets do fall, let's say we write that put contract, we sell that contract, and then we do see a pullback in the market that reaches that 15% down point, if that's the point that we've set in the contract, then we're buying into markets at those prices. So we're buying in at that 15% decline. So if the market does drop to that predetermined level, that's the price that you buy in. If you're comfortable buying into markets, but you're not necessarily comfortable doing it at today's prices, it's a way of giving you an on-ramp to get into markets. If you're sitting there and you're more or less fully invested, and you're wanting to look at taking some cash out of the market and paring back your stock exposure, you could do that by selling a piece of your stock exposure and using the cash that you raise from that sell to write these cash-covered puts that you would be selling. So the assets that it makes sense to use this for, again, really just cash that we're comfortable investing for the long term. Cash that we're looking at deploying into the market at some point. Maybe we've been hanging on to it and we're looking for better yield. This is a way to get a 4 to 6% yield on an annualized basis here, kind of in a relatively short period of time. What dollars does it not make sense to use in this kind of strategy? Don't use reserve cash that you're going to need to spend anytime soon. Because if we write this type of contract and markets fall, that whatever that level is that we set in the contract and we put the shares, then we're long in the market. You can certainly sell to raise the cash again, but it's probably not the best way to be thinking about this. If it's cash that you're holding that you think you're reasonably likely to need, then I would consider a different strategy other than this. But it's a good way to be accomplishing those goals of getting money put to work, having a plan in place to put cash to work in the markets over time. It's a good way to increase a little bit of the yield that you're getting on your cash. And it's kind of has a dual strategy of either on-ramping onto the market or off-ramping to reduce your exposure, at least temporarily. So if you have questions around this, or if this is maybe brought something to your mind that you'd like to run by somebody, please feel free to reach out, let us know, and we're glad to help. Thanks. Have a great day.